Live from New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, inflation data sending yields higher, teeing up even more rate hike calls and sending consumer sentiment to fresh decade lows. We begin with the big issue, Fed calls ramping up.
Inflation at 7.5%.
The Fed is way behind.
This was exactly what you did not want to see.
What's the Fed going to do from here?
Just get on with it. Let's do 50.
50 basis points.
A 50 basis points rate hike in March.
Just do it.
Whether inflation's 7.3 or 7.5%.
The market's already discounted it.
They're going to go, and they're going to go hard.
It seems very likely that the Fed's going to go 50 in March.
This is their chance to establish some credibility.
It has completely lost control of the policy narrative.
On top of that, there's a lot of political pressure.
People saying 50, 75, let's have an emergency rate hike.
All options are on the table.
All options are on the table. The panel today, Crossmark's Victoria Fernandez, Morgan Stanley's Tirupattur, and Jim Bianco of Bianco Research. Let's start with you, Victoria. Has your call for this Fed changed in the last 24 hours?
No, it hasn't. And I know there's been a big shock with Bullard coming out saying he wants 50 in March and 100 by July. But look, I don't think we should take what he says as gospel at this point. We've already had other Fed members come out and push back against that. We had Daly, we had Barkin, and I'm starting to feel like I'm on an island a little bit. As I say, I still think we only get 25 basis point hike in March because look, anything that the Fed does in March is not going to affect inflation this year. That's going to affect next year at 2023, right? Because you have policy affects economic activity, and economic activity affects the inflation component. So what's going to affect inflation right now? It's not going to be the March meeting. It's going to be what happens with supply chains and rents and wages. And what do we see right there, Jonathan? We see the ISM, the drop there. 40% of that drop was because supply delivery times were better than what they have been. That's a positive for inflation to come back down. You have new cars. For the last 8-9 months, new car prices were moving higher. Now they're flat because inventories are better. Yes, you have wages, you have rents that are going higher. I mean, look, I have a college student in New York and I'm looking for an apartment for her. Trust me, I understand that rents are going higher. But I think there's so much data in the next 5 weeks before that March meeting. I don't think we can, say in stone it's going to be a 50 basis point hike. Next week alone, you've got PPI, retail sales, housing data, Fed minutes, industrial production. I think the Fed is going to wait, get more of the data, and just do 25 basis points in March.
What a difference a tenth of 1% makes. 10 basis points upside on core CPI, and a lot of calls changed. 50 basis points from Citi, 50 basis points from Deutsche Bank, 50 basis points from HSBC. Nomura, to be fair to Nomura, they were already there going into that print on CPI yesterday. Vishy, I want to come to you on this. 7.5% inflation in America. How big is the gap between the facts on the ground and where this Fed is at right now? 0% interest rates, they're still buying bonds.
I think the where inflation is headed is higher. Our economists yesterday revised their expectations for next month's print. So we're now thinking, our U.S. economist Ellen Zepner is projecting 7.9% and for next month for the CPI print, and that's I think that takes into account a number of things that have happened. I mean, there are clearly a little bit of marking to market, as well as where I would somewhat disagree with my colleague Victoria here is I think there are where shelter inflation is playing a very big role. At the same time, also, if you look at what we will consider Phillips curve sensitive portions and the non-sensitive, so the cyclical and acyclical, we have seen an uptick in both of those things. So, which is why we think that the inflation has not peaked, and we'll see a tick up further in February print.
Jim Bianco, the floor is yours.
Yeah, the Fed, I'm going to agree with Mohamed El-Erian, who had on this morning. The Fed has lost control of the narrative. We're talking about 50 or 25. What is it that they're trying to do? Are they trying to raise rates to just show that they care about inflation but not really deal with the issue? Or are they intent on saying that a 40-year high in inflation and the number of people that are complaining about it. Remember that according to political polling, the #1 issue in the country is inflation. It is not COVID. It is not Russia, Ukraine. It is not climate change or crime. It is inflation. Are they intent on dealing with that? If they are, then they're going to start with 50 and they're going to go and they're going to make it hurt, because that's the only way they can bring inflation down. Because yes, it is part supply, but it is also part demand. So what is the policy that the Fed's trying to do here? And I'm not sure that they know yet. They seem to want to find one that's going to make inflation come down, the stock market go up, and everybody's happy. Unfortunately, they got to pick one. They're either going to have to deal with inflation, which is where I think ultimately they're going to go and be more aggressive, or they're going to have to say they can't risk growth and let the stock market run back to new highs. And last thought for you, the consumer confidence numbers from Michigan came out today. They were just not good at all. 50% of the people in that survey said they expect their standard of living to fall in the next year because of inflation. So are we going to ignore that are we going to ignore that they're losing on their standard of living because we can't let the stock market have a 10 or 15% correction? So which way does the Fed want to go with this? It's going to be very difficult for them.
They got to pick their poison. This market's adjusted in a big way. We had a monster move at the front end of the yield curve. And let's think about what we have changed. We've adjusted the start of this journey. We've adjusted the pace that we'll travel at in this journey. And let's talk about what we haven't adjusted. The destination. I go through all these calls right now, guys, and I'd love your response to this. Let's take the Goldman Sachs call to start with. So they adjusted. They look for 25 in March, but they look for a hike at every single meeting. They get on board with Bank of America. But listen to the end bit of this, just the end bit of the research. This is what got my attention. And to reach the same terminal rate of 2.5 to 2.75. But we just do it earlier. Now, Victoria, I want you to go through these calls with me and just help me figure this out. We're going to do this sooner, get there quicker, but ultimately the destination does not change. What do you make of that?
Yeah, that doesn't surprise me. And I think that's what a lot of people are thinking. The quickness that they want the Fed to move at, that slamming on the brakes, hurry up and do something in order to make an impact. All that's going to do is pull everything forward. They're right. Terminal rate is still around 2.5%. That has not changed, and I don't really anticipate that it's going to. So it is just a matter of timing at this point. Do they do it slow and steady, or do they do something very quick, which goes to Jim's point of the volatility that we're going to see in the market if they go quicker? I think Powell is trying to avoid that and not affect growth too much. I mean, you look at the New York Fed, their weekly economic index. Right now, that's saying on an annual basis, first quarter growth is looking a little bit north of 6%. That's much higher than what people were saying a couple of weeks ago. So I do think you end up in the same point. It's the path to get you there that's going to be the determining factor on how the market reacts.
Vishy, push that through the market for me. If the destination doesn't change, but the pace and trajectory of rate hikes does, can you help me understand, Vishy, how you push that through a yield curve just slightly differently, through the credit market slightly differently, to front load rate hikes instead of spreading them out?
It is very tricky. I think that what the Fed has on their hands is a very tricky problem to tighten financial conditions, but tighten financial conditions not so much that the growth tips over. I think it's and you layer on top of this the balance sheet issue. I think it's important that the when and how quickly when not only Fed stops the tapering is over, but also when we start to unwind the QT kicks in. So you take, I think each of these things, there is really not a tremendous amount of historical precedence to base what the market reaction is going to be or what the economic growth reaction is going to be to these changes. So I think we can't completely ignore that we are in fairly uncharted territory at this point. When we have such a massive policy support, you take those training wheels off, it is going to be substantial amount of hiccup. That means the risk assets, from the valuation perspective, risk assets across the board need to readjust to allow for a greater amount of risk premium, whether it's in the term premium in the term structure of the yield curve, or in credit spreads. I think, or in equity markets for that matter, valuations need to readjust. And that's the key message we are telling them.
We can revisit the credit story in just a moment. Jim, I want to come to you on treasuries. Balance sheet reduction in the mix as well. I'll talk about Mark Cabana of Bank of America a little bit later in the program, but Mark Cabana was talking up $1 trillion of balance sheet reduction this year, $1 trillion again next year. And Jim, my first thought was, OK, if we're going to go 7 hikes in the way that Bank of America thinks we are, and you throw on top $1 trillion of balance sheet reduction this year and next, Jim, what does this yield curve look like?
I think it's going to invert is what it's going to wind up doing, because keep in mind, you can do $1 trillion of balance sheet reduction this year and next year without the Fed selling anything. They could just let bonds mature. They buy about $100 billion a month just to keep the level of the balance sheet the same. So what I think the terminal rate and 7 rate hikes and everything is trying to tell us is that we're probably going to see the yield curve invert by the second half of the year. And that's always been a signal that something is wrong when the yield curve inverts. It's 8 for 8 in predicting recessions over the last 50 years. Now, if it inverts in the middle of the year, the recession could still be 2 years away. It could be even longer away, or it could be 4 months away or so. But I do think that as we go forward with all of these aggressive rate hikes, if the Fed is intent on attacking the inflation problem and with QT that does not require selling, you're going to see the front end of the yield curve continue to move substantially higher, and you'll probably have an inverted yield curve, and that will be your signal that something's wrong, and we probably broke something along the way, and we'll eventually find out what it is.
Jim Bianco sticking with us alongside Vishy Tirupattur and Victoria Fernandez. Coming up on the programme, up next, the auction block. Primary markets going quiet with issuers navigating the volatility. That conversation just around the corner. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe with a flurry of deals boosting weekly issuance to the highest level in 3 weeks. Volume reaching 40 billion euros despite ending the week with another zero-deal Friday. Surging volatility weighing on US corporate bond sales, high-grade issuance falling short of weekly estimates despite recording its busiest day in about a month. And the high-yield market remaining sluggish as well. Junk bond sales coming in below $3 billion, recording its slowest week since mid-December. It's not just rate hikes we need to think about, it's balance sheet reduction as well. Bank of America's Mark Urbano got our attention in a big, big way this week. Take a listen.
The balance sheet reduction will start in May, and it'll go pretty aggressively. The Fed will likely have 100 billion caps, redemption caps on treasuries and mortgages. 60 billion treasuries, 40 billion mortgages, and they'll phase into that over a 3-month period. The Fed will see their balance sheet shrink by $1 trillion in 2022. Again, that's $1 trillion in 2022, and another trillion in 2023.
Pause. That was my first thought. Just pause, stop, wait. Mark Urbano, $1 trillion this year, $1 trillion next year. Vishy Tirupattur, let me come to you on this. Can you give me your base case for balance sheet reduction? Where on earth do you get those numbers from? And what on earth do you think it will do to this credit market?
Right. I think the key thing to keep I would be on the less than what the numbers that you just heard. I think the caps will also be somewhat lower on the balance sheet reduction. I think the key to focus really is would there be any eventual sales, when there would be sales, and how that would affect. I think the key point how the transmission to the credit markets is really through the agency MBS market. I think people might underestimate how important the role, how big the role that the Fed has played in the agency MBS market relative to the role that they are playing in the Treasury market. A third of all outstanding agency MBS are held on the Fed balance sheet. So if they, and this is the highest number, and in fact, if the Fed is no longer not only not buying, but potentially providing what I would call negative supply to the market, that means the amount of mortgages, MBS, that the private market, the non-price sensitive, non-programmatic, non-hedging, and hedging counterparties, the private market has to absorb, is the highest number that the market would have to absorb at any time. So that means that the mortgage spreads have to get significantly wider than what they are today, and that will put some pressure on the investment grade part of the credit markets. And so what we see now is that the with the credit market, it's not a fundamental issue. It's really a relative value valuation issue and not a fundamental issue of credit metrics. So as mortgage spreads widen and investment grade spreads, we think will follow, we'll have to readjust to higher mortgage spreads to get incremental allocation. So that's the transmission mechanism that I'm most interested in watching. And if there are any talk of sales or putting floors as opposed to caps, any of those type of discussion would make this widening more pronounced and happening faster.
Vishy, the piece of that I want to sit on is how that bleeds out into credit and whether high yield comes along for the ride in a big way as well. What's the call you're making here? How much have you lightened up on taking risk in pockets of credit, or more broadly perhaps in fixed income in America?
Absolutely. I think this is a duration issue and not a credit issue. So therefore, if you look at what's happened year to date so far, it is longer duration has underperformed lower quality. In other words, lower quality has outperformed longer duration thus far. And that's something we would expect to continue going forward. And therefore, our call basically is leverage loans, which we have seen a lot more inflows into that, but it's a floating rate instrument, high yield credit, leverage loans. So leveraged loans over high yield bonds, over investment grade. That ordering is what we are telling clients to do. So we do expect that for high yield bonds and investment grade credit, spreads will be wider and the excess returns will be negative for the year. But where we think there is greater value is in the part of the market where there is only predominantly credit risk and not much of duration risk. That's leverage loans.
Well, at least there's a trade to make and you're willing to put money in this market, because if we're thinking about Q4 2018 and a repeat of that, Jim Bianco, that's a market I don't want any part of at all. I'll sit that out. Jim, what's the risk of a repeat of what we saw at the back end of 18?
Yeah, I think there is a risk there. Just feeding on what Vishy was saying, look, the Fed is the biggest player in a lot of these markets, and they're going to leave. And I've been fond of saying that the bond market will find funding. It will force other markets to fund it by raising interest rates or making those markets unattractive by seeing them increase volatility or falling as well too. And this is going to be a big problem as we move forward from here. In total, before we started the taper, the Fed was buying $1.5 trillion worth of bonds a year, $120 billion a month. And now if we're going to reduce at $1 trillion a year, or about $84 billion a month, then we're going to have to find $1 trillion from somewhere else in order to fill that hole that the Fed had. And it will be a challenge. It was a challenge in 2018, and it lasted for about 2 weeks. And then we had the famous Powell pivot where he said that the Fed would be patient and flexible, and that ended it. But this time around, with 7.5% inflation, I don't know if we can have another Powell pivot if the markets get messy. So it's the big unknown that we're going to have to jump into.
This sounds like challenging stuff. I like to take in a complete range of research. And Victoria, I think this will work with you. It's from RBC. The current pricing is close enough to the hawkish extremes of likely outcomes, and the risk-reward of fading it is too attractive to pass up. Now, Victoria, if I'm to sit here and say, you know what, things are going to turn out OK, we'll get that soft landing. The window's really, really small, but the Fed can nail it. What's the one thing you'd do today? If I can guarantee that scenario, what would you do in this market?
Oh, I love me a good guarantee, Jonathan. So if you're going to guarantee that, I think you have to turn around and really put all your eggs in the market and go, all right, let's go. We've got our balance between some growth and some cyclical and value stocks in the market. Let me get some exposure to some lower investment grade quality corporate, some of those BBB names where I'm not going to have to worry too much about spreads widening out, and really causing me some pain there. I would fill up my portfolio with things. I would go ahead and go all in. I mean, right now you have to look at some of the support that we're seeing, understandably, with the Fed not buying as much going forward. We've got to have some other parties come in, like Jim was saying. But look, you've got the 10-year auction this past year with indirect bidders at extreme levels. It actually traded through the when issued yield. So there is demand out there, even if the Fed is not playing. So I do think the market is going to be a little surprised that we don't have as many hikes as what people are pricing in. That does give you maybe a little more steepness on the yield curve. So I think you can get in those fixed income components, especially on that short end, and you're in a good position.
Victoria, Jim, Vishy, sticking with us. Still ahead, the final spread, the week ahead, featuring plenty of Fed speak and the FOMC minutes. That conversation up next. This is Bloomberg. Live from New York City for our audience worldwide, this is Bloomberg Real Yield. What a week we've had on that two-year yield, up 85 basis points year to date in a single day, up more than 20. That one-day move, the biggest move since 2009. And as twos come up and tens can't keep up, that curve is flatter, flatter, flatter. We've gone from 90 basis points, twos versus tens at the end of the first week of January to about 45 right now. Just think about the move we've had in a really short amount of time. That's some of the price action. Here's the final spread. The week ahead, coming up over the next 7 days or so. ECB President Christine Lagarde speaking on Monday, Eurozone GDP and US PPI on Tuesday. Then it's the FOMC minutes and US retail sales on Wednesday, jobless claims on Thursday, and just a host of Fed speak throughout the week. Maybe that's going to be the big event in and of itself. Mester, Bullard, Barkin, Evans, Brainerd, just to name a few. Keep an eye out for all of that. Back with us now, Victoria Fernandez, Tirupattur, and Jim Bianco. Just about enough time for the rapid fire round. 3 quick questions, 3 quick answers. Let's start with the month of March. March 16th, the Federal Reserve meets and decides a 50 basis point hike. Yes or no, Victoria?
No.
Vishy?
Yes.
Jim?
Yes.
What's higher at the end of the year? What's higher at the end of the year? The 2-year yield or the 10-year yield? The 2-year or the 10-year? Vishy?
Flat.
Jim?
2-year.
Victoria?
I'll take the opposite, 10-year.
10-year, okay. I guessed all of this after the last 20 minutes or so. Final question from me, just to wrap things up. Given it's Super Bowl Sunday, and this is my home now, Rams or Bengals on Sunday? Rams or Bengals? Victoria?
Let's go Bengals.
Vishy?
Rams.
Bengals,
Jim?
and it won't be close.
To the three of you, thank you guys, appreciate it. What an historic week in this market, in this treasury market. Victoria Fernandez, Tirupattur, and Jim Bianco from New York City. That does it for me. I'll see you at the same time, the same place next week. This was Bloomberg Real Yield. This is Bloomberg TV.